Imagine building the absolute backbone of the global AI revolution.
Right.
You land a landmark equity partnership with Google. You're growing your core technology by 70% year over year.
Unheard of numbers, honestly.
Yeah, exactly. And then, you watch your stock plummet 28% anyway.
It really is the ultimate disconnect, isn't it?
It's wild. So today we are opening up a fresh equity research report to find out why MRVL technology seems to be, well, punishing investors who thought they were buying the perfect AI stock. Welcome to the deep dive.
Glad to be here.
We are looking at a highly detailed report dated August 24th, 2026, and our mission today for you listening is to decode exactly what is happening under the hood of MRVL, which is currently trading at $237.04 share.
Yeah, and you have this company that fundamentally enables artificial intelligence to exist at a physical level.
Right.
Yet the stock chart right now looked like a roller coaster that just crested the Todd Hill and is in free fall.
And what a hill it was. I mean, over the past 52 weeks, MRVL's stock went on a historic run, up nearly 233%.
Yeah, so
But, you don't care about what happened a year ago. You care about right now. And right now, MRVL has pulled back sharply from its 52-week high of $329.88.
which is a heavy hit.
Yeah.
But I think it's important to establish that our research today is operating on a 12 to 24-month investment horizon.
Mm-hmm.
And despite that massive haircut in the share price, the report we are unpacking still gives MRVL a very confident 7 out of 10 bullish rating.
Wait, really? A 7 out of 10 after a 28% drop?
Yeah, which tells you the analysts believe the underlying mechanics of the company are stronger than the recent price action suggests.
Right.
When a stock gets cut by nearly a third, you're either catching a falling knife or you are looking at a generational entry point into a company that is just, restructuring the entire semiconductor landscape.
So to figure out which one it is, we need to look at the catalyst. The biggest news driving this company, and frankly the entire sector right now, happened just this month.
Yep, August 2026.
Here's where it gets really interesting, because MRVL announced a landmark deal with Alphabet, but this is not a standard supply contract.
Not at all.
The deal actually includes a defined path for Alphabet to acquire up to a 7% equity stake in MRVL.
What's fascinating here is that taking a 7% stake in a company of MRVL's magnitude is an incredibly aggressive, highly strategic maneuver by Google.
Yeah, it's huge. Because normally this isn't just Google buying chips, right? This is like a landlord buying a stake in your restaurant instead of just charging you rent. It changes the whole relationship.
That is a great way to look at it. Historically, the semiconductor industry relies on the merchant-supplier model.
Right, the vendor model.
Exactly.
Yeah.
A company like MRVL designs and manufactures a chip. A hyperscaler like Google or Amazon buys millions of them. They plug them into their data centers, and that is the end of the transaction.
You get handed a blueprint, you fulfill the order, you get paid.
Yeah, but taking an equity stake fundamentally alters the DNA of that relationship. When Google owns 7% of you, MRVL's engineers are suddenly sitting at the same desk as Google's architects.
Wow, yeah.
They're designing the silicon side by side, literally 3 years before it ever reaches a data center rack.
Your incentives are entirely merged.
Exactly.
Yeah.
And that alignment of incentives solves the single biggest existential threat to any merchant silicon company, which is in-house substitution risk.
Because if you are Google, you're currently spending, what, tens of billions of dollars a year on custom AI chips?
Easily.
So the natural corporate impulse is to look at that massive expense and say, well, we have the smartest engineers on Earth. We should just design these chips entirely in-house and cut MRVL out of the equation.
Because why pay a premium to a middleman if you can build it yourself?
Exactly.
Precisely. But designing custom silicon, these highly specialized application-specific integrated circuits, or ASICs, it's incredibly difficult and resource-intensive. By taking an equity stake, Google essentially hedges its bets. If they use MRVL to build their custom chips and MRVL's revenue explodes, well, Google's 7% equity stake appreciates massively.
Oh, that's smart. It essentially locks in demand and provides MRVL with a multi-year revenue floor that competitors just can't touch.
It does.
And the financial projections attached to this are just staggering. The analyst assessments in our sources suggest this Google partnership could eventually create a path for MRVL's revenue to triple, hitting a blue sky target of $31 billion.
Yeah, but it is crucial to frame that $31 billion figure correctly. That is a long-term best-case scenario.
Right. It's not happening tomorrow.
No, it is not going to show up on the income statement next quarter. but it completely validates Marvell's custom silicon capabilities. It proves that Google looked deep into Marvell's architecture and realized they couldn't just easily replicate this in-house.
Which means Google isn't handing out 7% of its company out of charity. They saw something in Marvell's technology stack that they absolutely had to have. So what exactly did they find? Because when you look at the breakdown in the report, data center operations now make up roughly 76% of Marvell's total revenue.
They've transitioned into essentially a pure-play data center infrastructure company. Management has a very clear line of sight, targeting $16.5 billion in revenue for fiscal year 2028. And they are backing that up with a massive $75 billion lifetime pipeline in custom silicon.
That's a huge pipeline. But here is where I think the broader market kind of misunderstands the AI hardware space.
How so?
Well, everyone is obsessing over the brains of the operation. The market treats the AI accelerator chips like they're the only thing that matters.
Right.
But having millions of state-of-the-art AI accelerators without the right interconnects, it's basically useless. It's like having a Ferrari engine but driving in gridlock traffic.
That is the perfect analogy. It was the ultimate bottleneck. You can have the fastest processing units in the world, but if they can't talk to each other instantaneously, the entire system grinds to a halt.
Right, because you aren't just using one chip.
Exactly. When you are training a massive large language model, you are networking hundreds of thousands, sometimes millions of accelerators together so they act as a single giant brain.
It's just mind-blowing scale.
It is. Moving petabytes of data between those chips with zero latency is actually a harder physics problem right now than the computing itself.
And you can't solve that physics problem with traditional copper wiring anymore. Pushing that much data through copper wire is like trying to force a fire hose of water through a pipe filled with sponges.
That is a highly accurate way to visualize the physical limitations of copper.
You get massive resistance, you lose energy, and it generates so much heat you essentially melt the data center.
Yeah, the electrical resistance is simply too high for AI workloads. The only solution is optical. You have to convert the data into light and send it over fiber optics.
Which is like replacing that sponge-filled pipe with a fiber optic vacuum. The data travels instantly with zero friction and almost no heat generation.
And this is exactly what Google saw when they looked under the hood. Marvell's hidden gem is their optical interconnect business.
Yeah, and according to the report, it is growing at over 70% year over year.
That 70% growth rate is the engine driving the institutional interest. Marvell has achieved this incredibly rare dual-engine technology stack.
Right.
They designed the custom ASIC compute brains for the hyperscalers, but they also own the optical highways that connect them.
Oh, wow.
And the critical detail for anyone looking at the financials is that providing those optical highways is a significantly higher margin business than the custom compute side.
And they didn't just stumble into this either. The report highlights some very strategic acquisitions that show exactly where Marvell thinks the industry is going.
Yes, the Celestial AI deal.
Right. They acquired companies called Celestial AI and XCon, pushing them aggressively into advanced photonics and a protocol called CXL.
CXL, or Compute Express Link, is arguably the most important technology standard you will hear about over the next 5 years.
Okay, break that down for us.
Historically, every CPU or AI accelerator in a server rack has its own dedicated pool of memory. If one chip runs out of memory, it can't just borrow from the chip next to it.
It's just stuck.
Exactly. CXL breaks down those walls. It allows every chip in a massive cluster to dynamically share a single massive pool of memory.
It basically eliminates the memory wall.
It does. And to make CXL work at scale, you need flawless, lightning-fast interconnects, which leads right back to Marvell's optical dominance.
So they are building the plumbing for a post-GPU architecture that won't even be fully realized until the end of the decade.
Precisely.
Okay, let's unpack this, because I follow the logic on the technology, and the 70% optical growth is undeniably incredible. But this brings us to a massive contradiction in the research.
Let's hear it.
If they have the fiber optic vacuum, if they are dominating CXL, and if they just secured a 7% equity partnership with Google, why does their current income statement look like a disaster?
If we connect this to the bigger picture, you're looking at the classic profitability paradox of the semiconductor cycle.
Because Wall Street is looking at Q1 of fiscal year 2027, revenue is $2.418 billion, up 27.6% year over year. That top-line growth is fantastic.
Right, very strong.
But GAAP net income fell off an absolute cliff, dropping to $34.5 million in the most recent quarter. A year ago, it was $177.9 million.
Yeah, it's a stark contrast.
Revenue jumped nearly 30%, but profits were practically wiped out to near break-even. And because of that, they are sitting on a trailing PE ratio of 77x. They are priced like they are printing cash, but the accounting shows they are barely scraping by.
To understand that paradox, you have to look at how custom silicon programs are actually built.
Okay.
When Google awards Marvell a massive custom ASIC contract, Marvell doesn't just flip a switch and start manufacturing.
Right.
They enter a brutal phase of upfront investment.
Right.
You have massive R&D expenses, tape-out costs to finalize the chip design, and incredibly expensive non-recurring engineering, or NRE, costs to get the assembly lines ready at the foundries.
So they are basically buying this future revenue at the expense of their current margin.
In the short term, yes. The mix of their revenue is shifting. Because they are ramping up these massive lower-margin custom ASIC programs for the hyperscalers, it is temporarily dragging down their overall GAAP net income.
It costs a fortune to get the flywheel spinning.
Exactly. But if you look at their trailing 12-month gross margin, it is still holding at 51.5%.
Which means the underlying economics of the chips themselves haven't collapsed. It's the upfront operational spend eating the profits.
Right.
But I'm going to push back on that 77x multiple. The market is incredibly unforgiving right now. A 77x price-to-earnings ratio means investors are paying a massive premium today for profits that might not materialize for 3 years.
Which is why the report directs our attention away from the GAAP accounting and toward the actual cash flow.
Okay, let's look at the cash.
Wall Street is obsessing over that GAAP net income drop to $34.5 million. But if you look at the actual cash coming in the door, the story flips completely. Their calculated free cash flow proxy improved to $483.1 million for the quarter.
That is a massive delta.
It is. Their operating cash flow essentially doubled year over year. GAAP accounting forces them to recognize certain expenses and depreciations in ways that make the bottom line look ugly right now. But the actual cash engine, the dollars hitting Marvell's bank account, is roaring. They're generating more than enough cash to service their $1.1 billion in net debt, while still funding the R&D required to keep Google happy.
That distinction between accounting profit and real cash is exactly why this requires a deep dive. But even with strong cash flow, there is a gravity to a stock trading at 77 times earnings.
Oh, absolutely.
If you are priced for perfection and you rely on a future $75 billion pipeline to justify your valuation, any misstep is catastrophic. And I think that risk is perfectly illustrated by what happened to the share price.
Yeah. Dropping from $329 to $237.
Right, which means the market is actively pricing in the fact that this blue sky scenario might not happen.
The market is realizing that custom silicon is a binary business.
So what does this all mean? Because there is a data point in this report that screams risk to me.
The insider selling.
Exactly. Over the recent period, the report notes 7 open market sales by insiders, totaling over 56,000 shares. And on the flip side, exactly 0 purchases. Not a single executive bought shares.
This raises an important question. Seeing an insider sentiment score essentially bottomed out with 0 buys is notable, but you have to contextualize it within Silicon Valley compensation structure.
Okay, fair.
These executives received the vast majority of their wealth and equity. Selling 56,000 shares across 7 executives at roughly $300 a share is around $16 million.
Right.
For a company of Marvell's size, that is a relatively modest amount. They are selling to cover tax obligations on vested shares or simply diversifying their personal portfolio.
I hear that, and I know the standard line is, insiders sell for a million reasons but only buy for one. But 0 buys.
Yeah, it's tough to ignore.
If you are an executive sitting on a $75 billion pipeline and you just inked a deal that tightly integrates you with Google, wouldn't at least one VP be scraping together cash to buy at a 28% discount?
You would think so.
The stock took a massive hit, and nobody inside the building stepped up to buy the dip. It feels too convenient to just dismiss it as tax planning.
It is a totally valid critique. The lack of conviction buys from leadership during a 28% drawdown is absolutely a signal you cannot ignore. It suggests that internally, they might view the current valuation as fair rather than deeply discounted. But while insider selling is a red flag, the actual existential risk to the company's survival is customer concentration.
Right, because that $75 billion pipeline isn't spread across 10,000 customers. It is concentrated among a handful of titans.
The hyperscaler market is an oligopoly, and their behavior is ruthlessly predictable. They have a well-documented pattern of either dual sourcing, forcing Marvell to split a contract with a competitor to drive down margins, or taking the design in-house if the supplier stumbles.
And if they do dual source, the company standing right next to Marvell trying to eat their lunch is Broadcom.
Broadcom is the apex predator in the custom AI networking space. The debate over whether to allocate capital to Marvell or Broadcom is the defining argument in semiconductor investing right now.
Wow.
If Marvell loses just one major hyperscaler program to Broadcom, or if a customer decides to delay a generation of chips, Marvell's 77x multiple will compress violently. The growth narrative would be decimated overnight.
The report does mention one interesting counterbalance to that concentration risk, which is their aggressive push into emerging markets. Marvell is apparently drawing very aggressive AI price targets based on a bet they are making on India's AI infrastructure build-out.
Right, the India bet.
Getting real revenue from a massive emerging market like India would finally provide some geographic diversity so they aren't entirely reliant on 3 tech companies in California.
It is a critical secondary growth narrative.
Yeah.
But the key word there is secondary. In the immediate term, the entire company's valuation rests on executing for the hyperscalers flawlessly.
And we are about to find out exactly how well they are executing, because the clock is ticking loudly. This isn't just an abstract theory about what might happen next year.
No, it's happening right now.
Marvell reports their fiscal Q2 2027 results in just 3 days, on August 27, 2026.
The near-term horizon is incredibly compressed, and the stakes for this specific earnings call are monumental.
The consensus expectations are steep. Wall Street wants to see $2.71 billion in revenue, which would represent a 35% year-over-year jump alongside $0.93 in earnings per share.
That's a high bar.
So if I'm looking at this earnings call on August 27, the obvious thing I'm watching is if they hit that $2.71 billion top line mark. But what is the hidden metric? What is the actual number or statement that will dictate the stock's movement in after-hours trading?
The top line is just the price of admission. The hidden metric is the gross margin trajectory. We talked about how the custom silicon work is dragging down their overall margins while they ramp up. You need to watch like a hawk to ensure their gross margin stays above that 50% threshold. If it dips into the 40s, the market will panic, assuming the lower margin ASIC business is cannibalizing the highly profitable optical business.
Because margin compression would destroy that 77x multiple instantly. What else?
Listen carefully to the tone around the Google equity stake. We know there is a path to 7%, but management needs to clarify the vesting conditions. Are there binding, guaranteed revenue commitments attached to that 7%?
Okay, that's huge.
Because favorable terms with lock-in revenue will be viewed as massively bullish and could trigger a re-rating higher. But if the terms look onerous, it will raise immediate dilution concerns.
And I imagine they have to stand firm on that $16.5 billion target for fiscal year 2028. Any wavering on the multi-year visibility and the floor falls out.
Exactly. And remember, Marvell doesn't exist in a vacuum. The report points out that NVIDIA reports their earnings in late August as well.
Right, the bellwether.
NVIDIA sets the weather for the entire AI semiconductor complex. If NVIDIA signals any hesitation in broader AI infrastructure spending, Marvell stock will take a hit regardless of how perfect their own numbers are.
So, bringing all of this together, Marvell Technology is navigating one of the most complex transitions in the tech sector. They are evolving from a traditional merchant chip vendor into a deeply integrated strategic co-founder for the titans of the AI revolution. They have a brilliant technological moat with their 70% growth in optical interconnects and their positioning in CXL memory sharing.
But they are walking a razor-thin financial tightrope. They have to manage brutal upfront R&D costs while defending their margins, fending off Broadcom, and hoping the hyperscalers don't suddenly change their minds.
It's a high-wire act with no net, trading at a premium valuation. But stepping back from the stock price, this Google deal leaves me with a really provocative thought about where all of this is heading.
I'd love to hear it.
If tech giants like Google are now taking literal equity stakes in their hardware suppliers just to secure their AI infrastructure, does this signal the end of the open merchant silicon market?
It is a fascinating question. If the hardware is the ultimate bottleneck to artificial intelligence, owning the supply chain might be the only way to survive the AI arms race.
Are we heading toward a future where a few massive vertically integrated monopolies own not just the AI software, not just the data centers, but the actual companies manufacturing the physical hardware at the atomic level? It's something to mull over as we watch how this Google deal unfolds. Thank you for joining us on this deep dive into Marvell Technology. Keep your eyes on that August 27 earnings call, and we will catch you next time.